Thursday, January 28th, we're going to do a 1 hour training session on the relative volume and the relative density and the other volume indicators that I have here. Let me take these cursors off. So the thing with volume analysis, I'm not sure how much you guys know about performing volume analysis, but let's look at a couple of different charts here. Let's just create a crude oil 10-minute chart. There we are. Well, let's make it 3. And then we'll add volume to the chart. So if you know anything at all about volume analysis, you know that there is a kind of seasonality to volume. So obviously we have very low volume trading in the overnight, very high volume right at the open, and then we have a little bit of a lull during the lunchtime, the lunch hour, and then it picks back up again near the close. Okay, so crude closes at 1 p.m. or 2 p.m. Eastern rather, which would be, I'm sorry, 2:30, which would be right here, which is why we have that high volume. Okay, and then very high volume right at the open, which is at 8. And crude actually starts picking up about 2 or 3 in the morning Central Time for the European session. Okay, so we have this seasonality. We have typically very low volume in the overnight, a little bit higher until we get to usually about 7 o'clock, and then from 7 to 8 pre-market the volume starts picking up. Then we have very high volume at the open. We have usually a lull around lunchtime, and then it picks back up again for the close. Okay, so to compare the volume of the open to the volume of the pre-market or the overnight would make absolutely no sense whatsoever, right? I think that's fairly obvious to everyone. And guys, if you have any questions along the way, just type them out in the hip chat. Would somebody just type something in hip chat now just to make sure that it's working? I think mine is frozen maybe. And could you verify that you can hear me? Testing, testing. Yeah, my hip chat is not working. Let me refresh it. Okay. You love Bobby. Okay, cool. Alright. So to compare from 1 hour even to the next with the standard volume is essentially worthless. And that's why a lot of people will tell you that analyzing volume is a waste of time, because it's too hard to make sense of. You have very high volume at the open, and then it kind of slows down at lunch, so you have this wide variance between different hours of the day, so it's basically worthless to try to analyze it and make any sense of it. And there's some truth to that, obviously, but it is volume that is the most important piece of information that we have next to the actual price itself. It's the volume that trades that determines the prices of the market. All right, it's the buying and the selling that makes the market, that drives the price. So the price is actually second order. It's kind of the result of the transaction. So it's the transaction that is really the first order of information that we have. Okay, so to try to make sense of the volume is going to be key for you in analyzing the markets and in finding these important reversal patterns, retracements, confirming areas in the market geometry, things of that nature. So what we've done is we've kind of eliminated some of the seasonality and the variance simply by looking at volume per range. And the first guy, I couldn't be the first guy to do this, but the first guy to really write about that would have been Bill Williams. I don't think that Wyckoff ever actually really wrote about volume per range. He did, yeah, he did to some extent, but I don't think he ever displayed it as information. He would just look at the size of the volume bar relative to the size of the price bar, but I don't think he ever actually divided or combined the two. So if we look at volume per range, then you can see we have smoothed a little bit and eliminated just a little bit of the variance in the seasonality. I'll turn some of these off. I'll leave the EMA on. Okay, and what that volume per range is telling us, and this is where Bill Williams would come in with his, what did he write? He wrote a book called, excuse me, I think it was called Trading Chaos or something like that. Trading Chaos. And he would call this the Market Facilitation Index, all right, the MFI. And really he was multiplying, or no, he was taking range per volume. So he was taking the range of the bar, dividing that by the volume, whereas we're taking the volume and dividing that by the range to find out how many contracts is necessary to move that market every tick. All right. So here, on average, today, it was taking about 300 contracts to move the market every tick. Does that make sense? So it's volumes, total number of contracts traded per tick, and that is telling us how many contracts is necessary to move that bar every tick further. All right, so this is where we get into looking at what's called churn. Okay, so after Bill Williams wrote that book on Trading Chaos, I think it was even before that, Tom Williams wrote a book, what was it called? Mastering the Markets. And he started talking about volume spread analysis. So the spread would be the range of the bar. The Brits just call it the spread. We would call it the range. It's the high minus the low. So it's the number of ticks for the range of the bar. So he started talking about volume spread analysis and taking Wyckoff analysis kind of to a more thorough level. And that was one of the first books that I read, actually, after reading Edwards and McGee's, what was it, Technical Analysis of Stock Trends. I started reading that about volume because the blokes that I was working with, they were using market geometry and volume, but of course they were trading daily charts and weekly charts. And they turned me on to volume spread analysis and Wyckoff. And then, of course, Edwards and McGee was one of the required reading books for the exam that I was about to take before the market crashed and several of us lost our jobs. The market technician exam, what was it called? The CMT or something? Chartered Market Technician. So that was one of the books that was required reading. No, not CTA. This is different. This is a Chartered Market Technician. So CMT. It's basically a certified technical analyst, which is what I was going to take. I'll probably end up doing that anyhow. But some of these books were required reading, and then that's kind of where I got started in analyzing volume. Okay, so Tom Williams would talk about up thrusts and tests and kind of Wyckoff analysis, but taken to a little bit higher level. No, Clint, that was when I was working in Ecuador, so I was actually paid to do this. I was actually paid to study. Yeah, the CMT, exactly. There's level 1, 2, and 3. So anyhow, yeah, I was paid to learn different methods and to study for that exam. So at any rate, I started studying that, trade guider software and working with the volume spread analysis, and that was interesting, but it was obviously lacking in a lot of areas. It was more useful on daily charts and weekly charts, but for intraday charts, you can't get around this very high volume at the open, the lull during the midday, and then the high volume near the close. And it's a little bit different for crude oil. It's way more pronounced with something like the ES. So let's look at the ES. And Clint, do pay attention, because this is important. This is one of the most important aspects of what we do as far as our trading method is concerned. This is where the rubber meets the road in terms of doing proper analysis and finding these key reversals in the market. I think you guys in the room that are current members would definitely agree with that, as far as the relative volume is concerned, being one of the most important tools that we have. So what I wanted to do is I wanted to eliminate this seasonality in the volume. I wanted to be able to compare the volume just before the open with the volume right at the open. And I started searching, and I started thinking about, well, obviously you could compare today's volume at 9 o'clock to yesterday's volume at 9 o'clock, and just compare one time frame with another. And then I found where a guy named, goodness gracious, I'm going to forget his name, Brett Steenbarger. Brett Steenbarger had written a article one time about relative volume, and it's something that they had used at the fund that he worked for not Soros, what's that guy's name? Just a super massive trader. He's got a huge fund. Paul Tudor Jones. Okay, so Brett Steenbarger worked for him. Brett Steenbarger's father is actually probably in the room right now. He owns the software, and he works with us as well. So Steenbarger's father is usually in here with us as well. But anyway, so he wrote an article about relative volume and doing just exactly what I'm talking about, comparing today's volume from 9 to 9:05 with yesterday's volume from 9 to 9:05, and doing an average of, say, the past 10 or 15 days. And then he would use that to judge how much volume is trading going into the open, and if we're above 120%, then they would expect to hold their trades for a little bit further. They would expect more volatility. All right, if the volume were, say, below 90%, they would expect a more kind of a lower volatility day. And he kind of proved that out and said, it was about a 68% probability that they could rely upon that information as far as volatility. Trying to determine how high or low volatility would be on the day. So somebody created a basic version of the relative volume on Big Mike's. I took that and then applied some of, what's that guy's name that does the better volume? Barry Taylor. So he took volume spread analysis. I think his original version of the better volume was made more sense. Now he's incorporated the bid and the ask volume into it as well, which makes sense the way that he's doing it, but not nearly as much as the way, not logically, as far as I'm concerned, is the way I'm going to be incorporating the bid and the ask volume into the version for Ninja 8. But, I don't want to get ahead of myself and confuse you guys. So the rules that he came up with were for churn, and it's nothing fancy. I mean, this had already been done before. People just called it something different. Like the guys at VSA, volume spread analysis, they called it. No, I think they called it a churn bar. I'm not sure exactly what they called it, but basically they were looking for very high volume per range bars. So if we zoom in on this, let me just kind of explain to you what a churn bar is before we move on. That doesn't maybe work so well because it's right near the open. Let's do a 1 minute chart. That's a good example right there. All right, you see this? Right here. This bar right here is a lot narrower range than the previous 3, 4, 5 bars, right? But it's a very high volume bar. Okay, it's not as high as the previous bar, but when we divide the amount of volume by the range of the bar, then you can see that it is very high volume per range. All right, that high volume per range bar means that in that bar, there's a fight going on between supply and demand. Okay? Do you understand what I'm saying here? When you have very high volume per range, that means that it's taking the market more contracts to move every tick further than was previously necessary to move the market every tick. Now, this all makes perfectly logical sense once you start thinking about it, but this is what governs the movement of the market. And it's just a matter of finding these areas where you have a fight going on between supply and demand, and you can see it happening. And we see it happening all day, every day. That's why we're able to get pretty low risk entries on most of our trades. You know, just because there's a fight going on between supply and demand doesn't mean that it's going to be a complete reversal. It could just mean the price is slowing down. In this case, it was indeed a complete reversal. All right, as we're coming down, we have a huge amount of volume, sell off, but you can see here, it was just barely above average volume per range. So sorry, I'm kind of stuttering a little bit. So per tick, you know, the size of this bar, relatively, the same amount of volume was traded to move the market every tick. All right, yes, that's a lot of volume, but it also moved quite a distance. All right, it also moved pretty far. Now on the next bar, we have very high volume as well, not as high as the previous bar, but definitely much higher than the average and much higher than these bars. Let's say the average would be right here. Okay, so about twice the average amount of volume. But look at the range. So if I add the range on here, whoops. You see that it's below average, right? Just barely below average. So this is a very wide-ranging bar, obviously. And then the next bar is below average. But the volume is about twice the average. And then the volume per range is about twice the average. So that's what's called a churn bar, guys. All right? That means that somebody is coming in here now and they are supporting the market right here at this level. So if we were to look at the bid and the ask or the ladder, we could look at the little profile right here. Let's do this. Let's do like a 30-second chart, and then we'll look at the profile right there. So what time is this? Let me just mark it. Let's do like a 10-second chart. So is there anybody that's not really following me on what a churn bar is or what a churn bar means? It means there's a fight between supply and demand. It means very high volume per range. You guys got it? Any new guys in here having a problem? Yeah, Harold, it takes a little time to get the hang of this, but this is what drives prices. This is what determines the market. This is what determines the movement. This is what you'll see at most reversals. Now, there are several different types of reversals. We have about 6 or 7 different reversal patterns. Sometimes volume just kind of dries up as you go into a high. The buy-in will just simply dry up and there's no one left to buy, and then it just naturally kind of rolls over. But, we'll show a few different reversal patterns. A lot of times you'll have just a climax, a selling climax with a V bottom, and it'll turn right back up. But then very often you'll see what we see here, which is a selling climax followed by a churn bar. And that's a pretty common pattern that we see. Okay, so the volume started stepping in right here at this level. All right, so from about right here down, essentially what we had were a lot of orders sitting there, probably at limit, and absorbing all of that selling that was going on. So here we had a ton of selling step in, and that alerts bots, that alerts other big traders, so they see, wow, there's a lot of people going short right there. Wouldn't it be nice to trap all of those guys, absorb all of that, and then work it back up, and then stop them out, take all their money essentially. So that's kind of what's happening there. So they're absorbing all that selling. The market starts moving a lot slower. It's not going as far, but yet you still have the same amount of volume coming in. So you still have a lot of volume coming in, but now the market's not moving anywhere. So what's happening? They're sitting there with their bags open, and they're just absorbing all of that selling. And they're building a big, huge long position, and then they'll start working it back up out of that zone and start marking it up until they reach a spot where they start getting out, which was right here at that high. You see how much volume traded right at that high? Just about the same amount that traded down here at this level. Okay, so that's kind of the way things work. That's what a churn bar is. All right. So what I've done with a relative volume is I've eliminated the seasonality. All right, the variance between the sessions, the variance between the times of the day, the lunch hour, the close, all of that. So I took the idea of relative volume, refined it quite a bit, cleaned it up, made the code a lot more sophisticated, added in these different volume per range signals, volume times the range signals for looking at Climax Bar, selling climaxes, buying climaxes, and looking at the degree of churn or the degree of the volume per range, okay? And then I went one step further, creating a new indicator called relative density, where rather than the input being volume itself, the input is now volume per range, and we're looking at only the churn bar. So we're looking at the degree of churn or the degree of participation. So when I add on here the relative volume, you'll see what I mean about eliminating the seasonality and the variance between the sessions. Okay, so here's the relative volume. Let's get rid of the range. just so we have a little bit more room. Okay, so let's put that on top. Let's make it about a 3-minute bar. So here we go. Okay, so now here is the open. Starting to get a sore throat. Not a good sign. There is the open right there. It's actually the next bar is the open. All right, the time stamp that you see on the bar, the time stamp, is the time at the close of the bar. It's really the time at the open of the next bar, but Ninja does some really weird stuff with data, which has made programming that this volume profile just a nightmare, the way that they do volume and timestamps. It's very odd, but anyhow, so what we've done is we've eliminated the seasonality of the day and the variance between the sessions. So now what we're looking at, in this case, for this bar right here, good, Jeffrey, good. Yeah, you'll start to get it. There's a really good video on the website, on the sales page, that tells you basically what I'm doing here, but I think I go through kind of a PowerPoint presentation type of thing with it. So for this bar right here, which closes at 5:48, what I'm doing is I'm taking the volume, the 5:48 volume, that 3-minute bar. All right, I'm taking it of the previous day at 5:48. The day before that, and the day before that, and the day before that. And I'm averaging all of that together over the past 10 days. And of course, I could set that to 20, 30, 40, whatever. And we could even look at, rather than consecutive days, we could look at day of the week. So we could take that, that 5:48 a.m. bar, the volume for that bar, on every Thursday, and average those together. That's useful for Wednesdays for the crude oil report. But basically, using consecutive days, there's not a lot of difference between using day of week or consecutive days, except for performance. Obviously, using consecutive days is a lot faster and a lot less data is required to perform the calculations than would be required of using day of the week. Okay, so we use consecutive days. We're using 10 consecutive days. So I'm taking that 5:48 bar, averaging it, averaging the volume of the past 10 days of 5:48 bars, the volume for the 5:48 bars, dividing that by 10, and then comparing that with the volume that traded for this bar. So in this case, we had 7,143 contracts changed hands on that bar. Now, the norm, the average volume for that time period would be 100%, would be this indigo line right here, which is set to 100. You can see on the scale on the right. All right, 100 is the average for every single bar. Okay, so if that 5:48 bar, if the relative volume equaled exactly 100, then it would be precisely average volume. It would be just the typical amount of volume that traded for that bar. But no, in this case, it was 407%. All right, so that's 3.7 times greater not 3.7, 3.07 times greater than the average volume. Does that make sense, you guys? Anybody have any questions about that? So it's way, way more volume trading for this bar than would normally trade for that time of day. And then when we get into the colors of the bars, then we're taking into account the volume per range. We're taking the relative volume, dividing that by the range of the bar, multiplying that by the range of the bar. We've got different look back periods. And I'm looking for, and we've got a cheat sheet for that. Let me just post the cheat sheet and you guys can look at that and, you know, kind of read it over if you like. I normally don't do this, but just to give you guys an idea of what's involved in this. Okay, I've got a document called Relative Volume Indicator Notes. I don't know that that is the right one, but I'll load it anyway. And you guys can have a look at that. Let me just see. Yeah, the X's and all of these drawing objects are looking at the degree of the spike. So how large the spike in volume is. And I'll get to that, like Bobby said, here in a moment. Let me make sure that's the right one. Yeah, that's decent. So a guy in the room made this. I can't, ensure that it's exactly 100% accurate, but I'm pretty sure it's very close. So he has given you the different colored bars, what they mean, what the churn bar is. It's the highest relative volume divided by the range of the past 16 bars. It signifies that there's, more volume is needed to move the market every tick further than has previously been necessary over the past 16 bars. Right? And that shows you a fight between supply and demand. So yeah, this is a pretty good document. And that will explain here we have the different spikes in the volume. And I'll get to that in a moment. But he does a pretty good job of explaining the different colors and the spikes and all of that. And then we'll get to the relative density in a moment, which is that bar behind the relative volume. Okay. So, yeah, I'm going to remake that document. We're actually making right now it's about 150 pages. I haven't had enough time lately because of, what all we've been doing here, and I've moved into a new office, a new place. Still not really even at the office yet, but I have one. But anyhow, I'm getting everything set up. So the colors are all explained in that document. But what's happening here is we have both a Climax bar and a Churn bar. So you can see the previous bar, the previous bar was a selling Climax. This bar right here, which is why it's light blue or whatever color that is. Hang on 1 second. Hello. I'll be right back. Can you hear me, guys? Sorry, that was the electrician. Okay, can you still hear me? We're good? Okay, great. So, back to it. Excuse me. This bar is a selling Climax right here, which is why the outline of it is painted blue. All right. It's also an extreme spike in the relative volume. All right. Let me show you all of the different indicators that we had to put on this thing to get all these conditions figured out. And let me beef these guys up a little bit. Where are they at? Here they are. Okay. So I had to use all these different standard deviation bands, moving average envelopes, look at the high of the past 20 bars or 30 bars, depending on how I set it up, and determine the degree of the spike in the relative volume. So we have 3 different signals for the volume spikes. Okay, and typically at fairly strong reversal points, you'll have an extreme spike or a major spike. At little reversals, like right here, you'll have a minor spike. Like here, you had a minor spike. This was actually volume divergence. This is actually a pattern that we look for in Bloodhound, which is going to be programmed into these indicators. So I had to use all of these different standard deviation bands, moving average envelopes, and N-bar high, all this different stuff to figure out the conditions. All right, I'll leave that guy. To figure out the conditions for the spikes. Okay, now this percentage over here on the right, that's looking at the accumulated volume from the beginning of the session. All right, so that's what Brett Steenbarger was looking at, was that accumulated volume. So at this point, at 6:15, the amount of volume that's traded since the beginning of the session is pretty much right at the average volume that normally trades every session up until this point. So if that volume starts increasing or decreasing, then you know that you've got more volume coming in or less volume coming in. I think today we had pretty low volume. See, it ended up about 90%. So that's typically a low volume day. You can see that the volume was dropping off. All right. So for those volume spikes, I left one on. I left this moving average envelope on. For those volume spikes, you have the 3 different ones. You have the minor spike, which is here. You got another minor spike here, and look at what happens. You get a minor spike in volume. Boom, it turns back up. You get another minor spike in volume. It's also a weak Climax Churn Bar. You can see the buy-in pressure coming in because it's closing up above its midpoint. The next bar does the same and almost closes on its high, and then it turns back up. Here you get a buy-in Climax, which is also a minor spike in the relative volume, and what happens? It turns back down. It turns back down until what? Until you get a Churn Bar. What does a Churn Bar mean? What does it signify? Very high volume per range. It signifies there's a fight going on between supply and demand. Okay, it turns back up. And then finally, on this bar, If it were just a 1 or 2% more, you'd have a minor spike at that high as well, because you can see it's actually about twice as high as the volume 2 bars ago. So that is indeed a minor spike in relative volume right there. It just barely didn't meet the conditions. Okay, then as we start coming down, we get a major spike in relative volume right here, which is that little triangle, which is also a selling climax churn bar. So it's both a climax and a churn. Climax meaning that you have a lot of volume rushing in and it's a wide-ranging bar. Churn meaning that even though it is a wide-ranging bar, there's still so much volume that the volume per range is higher than the past 16 bars. So yeah, it's a selling climax, but there's so much volume that it's also a very high volume per range. And then what happens? Turns back up. Turns back up until what? Until you have another churn bar, signifying that you've got a fight between supply and demand, and you've got resistance sitting there, absorbing all of that buying. And then what happens? Then we get a lot of volume coming in and selling this thing down. We get a spike, an extreme spike. And anytime there's an extreme spike, if there's an extreme spike at a low, you'll get this support line coming off here. Okay, if there's an extreme spike at a high, you'll get a resistance line being thrown off, which you can see we had one right here. Okay, so here you had an extreme spike coming down. You get that support line. All right, this is Wyckoff's test, right? You get a down thrust. It breaks through some of these lows, and then it gets a little pushback, a little pullback, and then it comes back down to test that area. It was a successful test. Bounces off, comes back, tests it again. Tests for selling volume. There's a lack of interest. So a lack of selling, and then it turns back up. They start working it back up. Okay. Then we come back and we test this high. All right. Not a lot of selling comes in. Very little selling comes in actually. So then they work it back up. You follow me? So this indicator is key to what we do. It helps us confirm the areas that we're trading to and from. This is a picture perfect example, and this just happens to be on the chart right here today. Picture perfect example. Too bad it was at midnight. Picture perfect example of one of the patterns that we look for. So here I've connected from high to high. The market comes down in a selling climax. You can see the buying pressure on that bar. How much buying pressure. It closed way up off of its lows, and it came down and it touched where, you guys? Where did it touch? Exactly where the median line meets the auto line. You don't see that very often, but when you do, it sounds like the most interesting man in the world. I don't see this pattern that often, but when I do, I drink a fifth of tequila. So it comes down and it hits that median line and auto line right at the 100% line. You see? So that is pretty cool. There he is, the most interesting man in the world. Awesome. So that's it. So we use the relative volume to confirm these areas. Here we've had the breakout, and then it pulls back. It's another pattern we look for. It's called the kiss goodbye. Comes down and it tests that high, and it tests that high. It tests that downtrend line, and then reverses off of it, and it takes off. Clint, we actually could put that on our charts. I'm going to do that when I get the channels programmed, automated. Anytime we have an extreme spike coming together at the median line and the auto line, I'm going to have the most interesting man in the world pop up. That would be perfect. All right, so that's a pretty thorough kind of explanation of what we're doing here with a relative volume. So we have eliminated the variance between the sessions, we've eliminated the seasonality, and we've made volume analysis, accurate volume analysis, possible. Whereas before, like most people say, it's pretty hard to do anything with. But now, with the relative volume and the volume spread analysis, or the kind of better volume conditions, and that's all about to be updated. I'm in the process of completely rewriting this. Some of the better volume conditions, I made them a little bit different, a little bit better in my opinion, but it still needed a lot of work to distinguish between different types of churn bars, different types of Climax bars. Like, we don't want to have a bar that's called, a Climax churn. That's not a good definition for what that is. There are better definitions for some of these types of bars, like this. This is not a buying climax, right? Because it's at the beginning of an up move. This is a selling climax right here. This is not a selling climax right here, even though it's labeled as one. So depending on where the bar is in the move is going to determine the definition for the bar. So the next version is going to be much more thorough, maybe a little bit more difficult to learn, but once you learn it, then you'll know what's going on in the market. You'll have a much better understanding of why prices behave the way that they do, why the market moves the way that it does. Everything will make so much more sense rather than just seeing what you think is random data, on a Renko bar. You have no idea why a Renko bar is turning up or down where it is. You have no idea. You see a reversal bar, you take the trade. But you have no idea what's going on inside of that bar. And if you look at volume on a Renko bar, well, that's pointless, because each reversal bar is the same size, and each subsequent bar might be one tick, or it might be 4 or 5 ticks. You have no idea, right? So when looking at volume, you need to be looking at it with either a minute chart, which is preferable in my opinion, a tick chart, which we'll get into in a moment, which is also useful but in a different way, or with a range chart. Now, we can use a range chart, but of course the churn bar is the highest volume per range, right? So when we eliminate one of the variables by using the variable as the chart type, well, then the signals take on different meanings. So for instance, when I use a range chart, one second. Okay, sorry. When I use a range chart and I put on, I'll show you one of the other indicators here. Tim is asking, what is my view of Forex tick volume? You can use it. But it, of course, it's not. It's a good proxy. It's all we have as a proxy. It's not going to be 100% accurate, but it is accurate enough to use, and you can definitely use this on the Forex data. I would rather use it on the Forex pairs. Even if you're trading Forex in a Forex account, you could do your volume analysis especially since you have relative volume and the time of day doesn't matter. You could do your volume analysis on the currency pairs, on the futures, and then trade the currency pairs. Okay? So if I were trading Forex, I would do my analysis, my volume analysis on the futures. And then I would trade the pair if I were, trading Forex, which I'm not. Now we do have one TTP volume range charts. Okay, this one doesn't have the paint bar conditions because the paint bar conditions are built from the range of the bar. And here, the range of the bar is always the same. It's always 8 in this case. So all we can look at with the range is the degree of churn. So the volume spikes take on a whole new meaning since we're using range charts as the chart type. All right, so when we have an extreme spike, that now means that is a very high churn bar. When we have a major spike, which you can barely see that one, I don't know why it's green, that is a medium-sized churn bar. And then the minor spike, and you can make these as large or as small as you want. If you have bad eyesight, you can make them gigantic. Doesn't matter. But the volume spikes now basically represent the degree of churn on the range chart. Personally, I don't really like using range charts and the volume. I get much more information out of a minute chart together with a tick chart. That's why I use minute and tick together, because combined you get all the information that you need. So this is a 1508 tick chart. Now I have the same conditions. We're not using relative volume for the tick charts. The next update will be able to do that. You'll be able to do relative volume on tick charts, on range charts, on any chart that you want. Even if you want to use some kind of weird exotic bar type, you'll be able to do that. But for right now, if we want to use the volume on tick charts, then we just use the one called TTP volume tick charts. Okay, and we have the same conditions built into these bars as we do for the relative volume. So we have churn, high churn. We have climax, so this is a selling climax. But what I also have is the volume per second, and that's what these black bars are. Okay, so for instance, when you get, as you get right here, when you get an extreme spike in the relative volume, in the volume for the tick chart, this should really be a climax bar too. That's another one of the reasons why I'm rewriting this. I think I can, I already know that I can. I'm in the process of making it, but the conditions that I'm going to be adding to this are going to be much more thorough. So this should be a selling climax, but what it also is it's also very high volume per second. And of course it's very oversold, but that means that the volume within that bar, and this is a 1508 tick chart, that means the volume that made up those 1508 ticks came in rather quickly to form that bar rather quickly. Okay, so if it's a very high volume bar, that would mean that it's a very high number of average contracts per tick. So in this case, if this is a 1500 tick bar, then let's see, how many do we have right there? So 2235, and that is at 1045, 2235. So 2235 divided by 1508 So that's 1.5 contracts per tick on average. Whereas typically on average, we have about 1.15 or 1.8 contracts per tick. So that means we typically have a little bit larger size average. We typically have larger average sized positions being placed for that bar. So that typically means that we have a higher percentage of traders with deeper pockets. And what's happening is they're running this low, running those stops, and then working it back in the other direction. And this is probably going to be a lower median line or something like that. And it kind of broke through that lower median line, but look at that. Look at that. See how beautiful this stuff is? So to find that high, all we did was connect from low to low. And right where that median line meets the auto line is right where we have that weak buying climax right into that high, and then it rolls over, breaks that low, runs those stops, and then they start working it right back up. So if I connect from this side, let's see. No, it's going to be from this one. So when I connect from this high to that high, probably get the median line right there. Yep. So 80% of the time it will make it back to the median line. And that's what happened here. I literally feel myself getting sick every second. Okay. So the volume per second actually tells us a little bit more information as far as, how fast the orders are coming in. Typically when you have very high volume per second, that usually means that you have a lot of market orders coming in really quickly. So if you see let me find a good example of this. Well, this is a 1508. Let's look at the 233. So if you see, this is a good example right here. On the faster tick chart, you'll typically see these extreme spikes in the volume, churn bars, and then very high volume per second. This is a perfect example right here. And that's why volume is so key in what we do. So you see this bar right here? This is a churn bar, but it's also a narrow range bar. So it's narrow. It has a narrower range than the previous probably 15 or 16 bars, maybe the same exact range as that bar. Maybe the same exact range as that bar. But it's a very narrow range, but it's very high volume, so that's why it's a churn bar. But look what else it is. It's a very high volume per second, and it's coming in on bearish divergence. Okay, so what does that tell you? You've got a narrow range bar, it's very high volume, and all of that volume is coming in like that. A couple of seconds. What do you think that means? Just take a wild guess. What does it mean, somebody? Exactly, Bobby. Limit orders. So that means that somebody had limit orders sitting right there at that price, and you had a lot of people come in instantly and start buying market. All right, they're buying market, and it's all happening like that, but price isn't moving anywhere. Right? So if you have market orders coming in, buying, but price isn't moving anywhere, what does that tell you? It tells you that there's a big boy sitting there with all of his limit orders, absorbing all of that market order buying. And then they're about to market back down and stop all those people out. See? And then it came up, it tested that spot again. Same thing happened, although not very high volume per second. But again, a churn bar, the same spot. And then it came back up, it tested that area yet again. And then finally They were able to push it down after about, what, an hour and 10, 15 minutes. So that's what the volume enables us to do. All right. I'm not going to lie to you. It's not easy to learn proper volume analysis, but it's what makes the market tick. I mean, it's why prices are made. It's why we have a market. It's why we have a chart to look at all these different prices within a bar. That's all created from the volume. So doesn't it behoove you to learn why the market moves the way that it does? And kind of understand volume a bit better? Because it is the volume that's determining price. So volume is the first order of information that we have. The second order is price. And people say price is the most important. Well, isn't the first order of information more important than price itself? So when I'm asked, what is the most useful methods that we have? Well, I always say it's kind of a toss-up between the volume and the market geometry. But the market geometry is obviously using price and only price. If I could only have one tool, just one tool only, it would be the market geometry. Okay? But it's the volume that makes the trades that I take with the market geometry so much higher probability. All right, that's what really increases for one thing, my risk to reward, my, what's the word I'm looking for? Profit to loss ratio. That's what gives me a performance like this, is having that ability to look inside of the bar and see exactly what's going on with the volume, and being able to confirm the areas in the market geometry across the multiple time frames, and then end up with a win-loss ratio like that, 3.2. And then, percent profitability is still very high. I would say anything over 45 with a win-loss ratio like that is considered pretty good. I would say anything over 40 with a ratio like that would be good. You'd still be making money. And then my profit factor, of course, is 5, which is down from about 7. But anything over 2 is considered good. Anything over 3 is considered, beyond exceptional. Anything over 3 is really considered impossible as far as day trading is concerned. So, pretty awesome results, and that is because I'm able to confirm the areas in the market geometry using the volume and the relative volume especially. So we've got the relative volume, and then we have the volume and range indicators, which work on the tick charts, the range charts, and all of that. But the update for the relative volume is actually going to work across any chart. So all of this stuff is going to be updated for Ninja 8, and it's going to be so much more thorough and just a lot, I would say, a lot more accurate signals. It's going to make a lot more sense. Be a lot more logical. Okay, so are there any questions about any of this? I just wanted to give you guys an overview of the different volume indicators that we have, why they're so important, and how they kind of confirm what we do here. It's really the relative volume that is the backbone of the confirmation of the areas that we trade with the market geometry. And you can see here where we had the spike, we had the extreme spike in the relative volume. So I mean, if this is not an obvious one, I don't know what is. This is about as obvious as it gets. You see that? Again, right where the median line intersects the auto line. How many times have we seen that? just in the past 2 days. Just in the examples that I've given you on 2 charts. And then look for the timing thing that I created. It turns up right at the end of this line here. So that's a separate product. That's the toolbar. But it's the toolbar that determines the areas. We use the toolbar to determine the areas and look right down to the value area low. So retrace down to the value area low and then turn back up. So we define the areas and then we confirm the areas with the relative volume, and look at the confirmation we had right here. We had a buy-in climax, which was a extreme spike in the relative volume, and it met the 100% extension of this move. Right where the median line intersects the auto line, and then see it threw off a resistance line because the volume was so high there. And then when it came back up and tested that area, again we get a churn bar, which if you're looking at the volume, doesn't really look like anything exceptional, right? And yet it is. It's very high volume per range, indicating that there's a fight between supply and demand, or that in this case, because we're at a high, we have supply coming into the market. Okay, then we come back up, we test it again right here, and we have a weak climax churn bar right there, which again doesn't look like anything special with the standard volume. Okay. So pretty interesting stuff. I mean, this is where the rubber meets the road in terms of real market analysis. This is not trying to form fit your equations that you've fallen in love with, mathematics, onto chaotic data. It's not what we're doing here. We're taking the volume data and trying to make sense of it, eliminating the seasonality and the variance between the sessions, and actually be able to use the volume data effectively for finding these major reversal patterns. Okay, so I've been talking for about 1 hour and 15 minutes, and I need to go get some vitamin C or something here and drink some water. So good stuff. I think it's self-evident. I don't need to tell you how awesome this stuff is, even though, I mean, you can see my results and know right away that the stuff is obviously very useful and very good. But it's taking technical analysis to a totally different dimension. So when I get all this stuff created the way that I want it, with all the right equations for the different types of bars that we have, the different degree of churn and climax, and whether it's a climax or it's the beginning of a trend or a reversal or something like that. Once I get all that ironed out, the version that we have for Ninja 8 is going to be pretty spectacular, and it's going to work across tick charts. And what I'm going to do is I'm going to build, basically we'll do the calculations on one chart. So the only problem with the relative volume is that we have to load a certain number of days back. Like here I've had to load 15 days. So depending on how many days you're looking back, you've got to look back on the chart about twice as many days as you're looking back in the indicator. So it can get to the point to where you're loading too much data on a lot of charts. So I'm going to build it to where we do the calculations on one chart, or even within the market analyzer, and then we access that data from all the other charts, and then we only have to load 4, 5, 6 days, or let's say 500 bars on the chart, and then we run all the calculations from the base chart that we've run the relative volume calculations on. Do you follow me on that? We're going to do all the relative volume calculations on one chart. We're going to access that data and then run the relative volume per range, relative volume times the range, the volume spikes, all the different paint bar and spike analysis on each chart independently using the data that we've built on the other chart. So it's essentially going to take the relative volume and make it, 100 times more efficient. So we'll be able to use the relative volume across 50 or 100 or 200 different charts. We'll be able to monitor multiple different markets across higher time frames, and then get alerts when we have different conditions being met on all of these different charts. So rather than looking at ES and CL every day, we'll have running in the background 40 or 50 different markets. We'll have Forex, we'll have stocks, and then when I see, or when the computer sees a certain set of conditions coming together, then we get an alert. That chart comes into focus, and then we can make a decision based on the layout of what we see. All right, but it will make that, doing it the way that I'm going to do it for Ninja 8 is going to make all of that possible. We'll be able to run as many charts as you want. And I'm doing the same thing with the Divergences Pro as far as not plotting drawing objects out of the purview of the chart, if you understand what I mean. So we wouldn't be drawing. So as I scroll back, there are all these drawing objects, right? I'm also going to do that with the relative volume. So as we scroll to the right, all of these drawing objects would drop off of the chart. So we would only be plotting the drawing objects for the visible chart. It's the drawing objects that slows Ninja down. That's what makes the load time so heavy, and that's what kind of slows everything down. So if we can eliminate more drawing objects, the more drawing objects we can eliminate, the better. The faster Ninja will run. And then Ninja 8 is going to make all of that so much faster. We'll be able to make use of our supercomputers, and it's going to make trading so much more fun and so much more accurate. We're going to be killing it. We're already killing it, except for today. Daniel messed up a little bit today, but it happens, whatever. Yep. So that's it. We're going to have some spectacular software. And it's only going to be for sale for, I think, the rest of the year. And then I'll be fading off into the sunset. So Ninja 8 should be out of beta by the end of March. As well will my stuff. So that's it. I just wanted to give you guys an overview, the relative volume and the volume indicators. If you're interested in the package, I'm not trying to sell you anything today. I just wanted to give you an idea, a better understanding of what this stuff is all about. Clint, what is the link? Yeah. So when will the new version of the relative volume be ready? I've got to design it, finish designing it, and then write it. I would say probably April. Maybe March. What does one mean fading out? Fading off, riding out into the sunset, fading out into the sun? That means getting out of Dodge. I'm going to stop selling, shut this thing down, only have the trading room, and then we'll do the trading room for a couple of years, and then the best guys in the trading room will hopefully come off and start doing a proprietary trading firm with me. So that's the future. God willing, we'll see. We'll see how it turns out, but that's kind of my plan, is to take and sell this stuff for about a year, get enough people owning it and in the trading room that I can pick out the top 10% of the performers, the top 5%, which needs to be at least 20 people. So I would need, roughly 400 people in the room and owning the software. But not only owning the software, but participating in the room, and then hopefully end up with 10 or 12 guys that would be really willing to participate in a trading room. So I need to sell it long enough and to enough people that statistically I could end up with 10 or 12 people. You know what I mean? So I'll only be selling this for as long as it takes to do that, and then I'm out. All right, you guys. I'm taking off. Have a good evening. We'll see you again in the trading room tomorrow. And hopefully I'll be able to get to all of your emails, which I have a couple hundred of them, and then get these videos edited and uploaded. All right, so have a good rest of your day, and we'll see you in the trading room again tomorrow morning. All right.